principal who moves to Dubai but retains a UK domicile, a German lease, and passive board seats in their home country has not exited. They have merely relocated. The Home Jurisdictions Tax Authority does not care where you sleep. It cares where your economic center of gravity sits. Cyprus is the bridge that closes this gap. An EU-compliant jurisdiction with a 2026 reformed residency framework that allows the structured, auditable migration of the center of vital interests from any high-tax origin country. Cyprus occupies a unique structural position. It is simultaneously an EU member state which confers OECD and FATF legitimacy, a common law jurisdiction that enables Anglo-Saxon trust structures, and a jurisdiction with the most accessible non-dom pathway in Europe. The 2026 reform package, which was enacted on December 22nd, 2025, and came into force on January 1st, 2026, did not dismantle these advantages. It reinforced and extended them. Cyprus offers two statutory routes to individual tax residency. The 183-day rule, which is based on physical presence exceeding 183 days in a calendar year, and the 60-day rule. The 183-day rule remains unchanged by the 2026 reform. However, the 60-day rule was amended in a targeted but highly consequential way. Prior to January 1st, 2026, the 60-day pathway contained a fifth condition, which required that the individual must not be a tax resident in any other jurisdiction in the same calendar year. This condition was a structural barrier for internationally mobile principals, who by definition retain fiscal ties in their origin country during a transition period. The 2026 reform removed this condition entirely. From January 1st, 2026, an individual can qualify as a Cyprus tax resident under the 60-day rule, even if they are simultaneously treated as tax resident in another jurisdiction. This is the architectural keystone of the Cyprus Bridge thesis. The removal of the non-resident condition means a principal can establish Cyprus tax residency and non-dom status before they have fully extricated themselves from their home country. Cyprus becomes the fiscal anchor point during the exit process, not after it. This is the dual-residency bridge. Treaty tiebreaker rules under the relevant double tax treaty will then be the arena in which Cyprus residency is asserted, and Cyprus has 67 such treaties. Where two jurisdictions claim concurrent residency under domestic law, the applicable double tax treaty tiebreaker hierarchy will determine treaty residence. The standard OECD tiebreaker sequence starts with permanent home, then the center of vital interests, followed by habitual abode, and finally nationality. The non-domicile regime is the primary economic incentive for high net worth principals. Its central mechanism is an exemption from the special defense contribution known as SDC. This is the levy that would otherwise apply to dividends, interest, and for periods prior to 2026, rental income for Cyprus domiciled residents. Corporate tax was raised from 12.5% to 15% for tax periods starting on or after January 1st, 2026, aligning with the OECD Pillar 2 Global Minimum Tax Standard. For our purposes, this is a narrative asset rather than a liability. The 15% rate is the proof point that Cyprus is a whitelisted OECD-compliant jurisdiction, not a low-tax haven. This is the credibility argument that distinguishes Cyprus from offshore alternatives that cannot withstand home country audit scrutiny. The deemed dividend distribution rule was abolished for profits earned from January 1st, 2026 onward. Principals can now retain and reinvest profits indefinitely within the Cyprus structure without forced distribution or phantom tax charges. This materially enhances Cyprus's utility as the holding layer before the Delaware and private equity structures we will discuss in episode 8. For non-dom principals, the post-2026 corporate structure is simple. The Cyprus company pays 15% corporate income tax on profits. The remaining profits can be held indefinitely without a deemed dividend distribution penalty. When distributed, dividends to the non-dom shareholder are subject only to a general healthcare system charge at 2.65%, capped at €180,000 annually. This results in an effective overall tax on passive and dividend income of approximately 17.65% at the corporate level, with a trivial personal level charge. This episode must address the compliance dimension directly. Cyprus's appeal is strongest for audiences who understand that a structure must survive an audit rather than merely being theoretically advantageous. The defensive measures are not a threat to a properly structured Cyprus Bridge. They are its proof of legitimacy. A principal's origin jurisdiction cannot categorize Cyprus as a harmful tax regime or a blacklisted jurisdiction. Cyprus is an EU member state. It is Pillar 2 compliant, and it operates the automatic exchange of information with all OECD partners. The 17% withholding tax on payments to low-tax jurisdictions signals that Cyprus itself does not tolerate pass-through abuse. This is the architecture of a jurisdiction that passes scrutiny, which is exactly what the exit bridge requires. The exit bridge narrative must confront the specific mechanics of departing a high-tax origin country. The two most common origin profiles are the UK and Germany, each of which presents distinct exit traps. UK tax residency is determined by the statutory residence test. The principal risk for departing UK residents is the concept of sufficient ties, where if a principal retains UK ties, such as family, accommodation, or substantive work, they can remain UK resident even with under 16 days of physical presence. Germany applies an extended unlimited tax liability rule, where individuals who are German tax residents can remain taxable in Germany for up to 10 years after departure, if they maintain essential economic interests in Germany. The German exit tax under Section 6 of the German Foreign Tax Act may also apply, triggering a deemed disposal of shareholdings at exit. Under the OECD Model Treaty Article 4 tiebreaker rules, the center of vital interest is the second test used to resolve dual-residency disputes. Substance migration is the deliberate, documented process of shifting the center from the origin country to Cyprus. Elements include physical home acquisition through either purchase or long-term lease of a Cyprus residential property, Cyprus directorship, which means appointment as a director of a Cyprus company with board meetings held physically in Cyprus, local employment or business activity, registration via the Tax for All portal, establishment of a primary Cyprus bank account, and social and civic ties such as club memberships, healthcare registrations, and children's school enrollments. A common error is attempting direct migration from a high-tax origin country to a final destination jurisdiction such as the UAE, while bypassing a bridge jurisdiction entirely. The Cyprus Bridge model solves this, as Cyprus has double tax treaties with both major origin countries and major destination jurisdictions. The 60-day rule enables substance establishment while the origin ties are still being wound down. The psychological and administrative weight of this migration process is frequently underestimated. When we talk about shifting the center of vital interests, we are not merely discussing paperwork. We are talking about a fundamental realignment of your life's institutional touchpoints. Most principals are accustomed to having their tax affairs managed by a local accountant in their home country who understands the legacy system perfectly. Transitioning into the Cyprus framework requires a move toward a multi-jurisdictional mindset. You must effectively train yourself to become an active participant in your new structural reality. This means recognizing that the Tax for All portal is not just a digital interface, but the primary record of your fiscal existence. It means acknowledging that when you hold a board meeting, it must genuinely be held in Nicosia or Limassol, documented by local minutes, to demonstrate the management and control that tax authorities seek to audit.
This is the difference between a structure that exists only on paper and one that stands up in a courtroom. By proactively adopting this administrative rigor, by ensuring that your social, professional, and civic footprints are no longer in your origin country, but are firmly planted in Cyprus, you are creating a digital and physical trail that is entirely consistent with your tax filings. This creates a defensive wall of evidence that makes it statistically and legally difficult for a home country revenue service to challenge your residency. In the eyes of an auditor, you are no longer a resident of their jurisdiction. You are a resident of Cyprus who occasionally visits their country. This fundamental shift in status is what grants you the freedom to move, invest, and operate globally without the constant looming threat of a sovereign tax claim based on outdated residence rules.
Once personal residency and corporate substance are established in Cyprus, the final structural layer is the migration of assets into a vehicle that insulates them from the origin country's ongoing reach. The Cyprus International Trust is the primary instrument for this purpose, governed by the International Trust Law of 1992. The eligibility requirement is that the settlor must not be a Cyprus resident in the year preceding establishment. This is typically satisfied by timing the trust formation during the Dual-Residency Bridge period, before 17 years of Cyprus residency accrue, which would otherwise trigger deemed domicile. A final note is that every treaty situation is fact-specific. The Cyprus International Trust is not a secrecy vehicle. Cyprus participates in the automatic exchange of information, the Common Reporting Standard, and the Foreign Account Tax Compliance Act. All scrip claims should be framed as general information. Viewers should seek independent professional advice from Cyprus Bar-registered advocates and ICPAC-registered tax advisors. The exit bridge is your final structural hurdle. Without it, the inbound platform from our previous episode is merely a tax deferral, not a permanent tax solution. Once your fiscal footprint is anchored within an EU-compliant, whitelisted framework like Cyprus, you have effectively severed the exit trap that ensnares most internationally mobile principals. You are now positioned for the final piece of the puzzle, Episode 8. In that episode, we will detail how to deploy Delaware Limited Partnership and LLC structures. We will demonstrate how to layer your Cyprus holding company as a clean, EU-compliant intermediary, allowing you to interface directly with global venture capital and private equity ecosystems. This is where your structure stops being merely defensive and starts becoming a tool for high-velocity capital deployment. We will see you there.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.